Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and I'm once again joined by my good friend Doug Heagren. Hey, Doug.
Isn't it nice when you get to pre-record these versus going live there, Kirk?
Yeah. Oh, wait.
What?
Well, happy post Father's Day to all you fathers. Hopefully, how was your Father's Day, Doug?
So I was blessed with 15 years ago. My daughter was born about a week before Father's Day, and just because of the way things work with Father's Days and Mother's Days always be on Sundays, yesterday was not only Father's Day, but it was my daughter's 15th birthday. We were out of town at a soccer tournament. They were playing two levels up, so they are basically sophomores in league, and they were playing a senior level tournament. They won the tournament with a 4-0 sweep with 11 goals for and 0 against, and my daughter's the goalie, so a shutout is certainly
Nice.
commendable. Silas, could not think of a better way to spend Father's Day than being at a tournament with my oldest daughter and winning it. And what a birthday present. It was awesome. And the team, when it was done, they all painted happy birthday to my daughter on their legs and the team picture. It was really cool. Awesome day. And I hope everybody else out there is able to enjoy the same little moments that, make being a parent so wonderful in so many different ways.
Yeah, I couldn't agree more, Doug. Kudos to you and your daughter for the win. My son was in a lacrosse. My oldest son was in a lacrosse tournament this weekend, and this past weekend they didn't win it, but he had a lot of fun. Which, hey, what else can you ask for? And then I spent the rest of the day putting together a basketball hoop for my other son, who we had a hoop which is. No, it's rusty. It's not doing too well. So we got a new one. And so I spent like 4 hours putting that together. That was not easy.
No.
I thought that was going to be easier than it was. It was not. But
no, I bought a nicer one and had someone else install it because that does not sound like one of those projects where I would weigh the value of time and money and say that my time is worth saving the money. But kudos to you, Kirk. What a man, salt of the earth, a man of his hands.
I'm not a man who's good with his hands, Doug, but I figure it out. It probably would have took a normal man like 1 hour to put together. It took me like 4. So, but whatever. It's not it's the destination, not the well, I guess it's the journey, not the destination. So we got there, and it was fun. We although we got it done and we didn't have any sand to put in the base, so. We gotta go get that today. So it's extended Father's Day. My kids will get to use it because they're finally out of school, which is great.
You were late then. Yeah, I guess. I mean, I thought we were kind of late, but yeah, it's did your kids just finish up last week?
Yeah, last week, both of them. It's funny because I was found growing up like, oh, you start after Labor Day and you end before Memorial Day, but things have changed. But we yeah, I mean, up here in Massachusetts, all the schools are the same schedule. So both of them, one graduated Tuesday, one graduated Thursday. My oldest graduated junior high, so he's going to high school next year. So happy for him. My youngest is still at the same school for another 2 years. So yeah, it'll be fun, but it'll be a good summer. I'm looking forward to it. It'll be a lot of craziness, but it'll be fun as well. So this week we're going to have a run of awesome weather, Doug. We're going to have tomorrow through Thursday or Friday, it's going to be 90s, and I think Thursday will be in the 100s.
So we got the opposite. It's started thunderstorming Friday, and it's expected to be thunderstorms all the way to the week, every single flipping day. Yeah, that's so much fun. And I'm going camping. So I'm going scout camping next week. Pray that by that point it cools it off a little bit. It's not so totally hot, but we also are not getting thunderstorms every single day that we're camping out in temps. So anyway, yep. Right. It's like, well, the economy is like the weather. Let's talk about that.
Good segue, Doug. We're going to go into a bunch of snippets today because, like everything else, the markets are quite boring when they don't go anywhere. So we're gonna talk about a few things here. One of the things I want to talk about is the fact that, and I'll let Doug talk about it too because I know he has some metrics here, but the markets have been kind of boring. There's been actually a lack of breadth of returns. I'm gonna share some things that some people were nice enough to put tweets together for us. So the first one, let me see, let me bring up my screen here. Right, and there we go. All right, let's talk about the Dow Jones Industrial Average. The thing everybody points to because it's got the biggest numbers, and yet no one pays attention to it. It's the black sheep of the financial community because it is 30 stocks, so it's meaningless. And back in the old days, like 100 years ago, it had meaning, but right now it doesn't. Anyway, so the Dow Jones Industrial Average. Here is the returns for pretty much the last, what is that, 4.5 months. The returns, and yes, this is a chart crime in of itself because it doesn't go back to January. But I do want to point it out because it's really gone nowhere. It's up 0.18%, so almost zero in the last 4.5 months. Is that what you're seeing on your returns? Probably not, because most people are looking at other things. But this is 30 stocks. So what else do we want to point out? Also want to point out the S&P 500. So use this as comparison. This is the S&P 500. So also for similar, because this is a weekly. I guess it's a weekly. So it's basically hitting all-time highs. So we had a little sell-off there. Really little sell-off this year, and then it's at all-time highs. And yet it doesn't feel like it, does it? Because not all stocks are participating. So, Doug, what are you seeing with stocks with the breadth? What are we?
Well, so this is interesting. People talk about this a lot, and I want to bring it back that historically there's this chatter about performance during certain times of the year, and over the past 50 years, the S&P 500's return dipped to a monthly average of 0.27% between May and October, which is down from 1.05% the rest of the year. It's a highly generalized figure, and it fails to account for the fact that many stocks do outperform the benchmarks over the summer months. Okay, so but I think the reason I'm bringing that up is I think that's a perfect example of kind of what we're talking about here. The summer is a very interesting time for the markets. What am I seeing? Well, one of the things that I'm seeing is that, again, that we saw the highest weekly close of the S&P 500 history. But Kirk, take a wild guess when you talk about it. Doesn't feel like that. How many stocks in the entire New York Stock Exchange actually also closed at new 52-week highs?
I don't know. How many, Doug?
Take a wild guess on that one. 200? Well,
it's not.
It's 500 stocks. Got to be a lot of them, right?
Yeah, you would imagine if there's 500 stocks and we're hitting all-time highs, it's got to be more than half, right, Doug?
Yeah, that would be close by off by probably a couple hundred. So no, 12 stocks in the entire S&P 500 have closed at new 52-week highs. What have we been talking about for years is the S&P 500 is driven by the performance of a relatively few. It always has been. It's the way the algorithm or the metrics work. And once again, this is an example of, and I think it really plays into that generalization, right? Is that May to October tends to be a more subdued time. Am I telling you to sell in May and go away like some people suggest? The answer is no, because there's been some amazing summers where the market's done incredibly well, right? So you've got to be very, very careful with those generalizations. But there is some variables that go into play during the summer months that change the way the volume of trading that's happening on the market, and a number of other variables that do lead to a more generalized subdued amount. But there's also something that's just not new, is the fact that the S&P 500 is often driven by just a handful of stocks. And I think we're seeing that again. There's been some shifting there. The other thing too that just came out is that there's actually been some new numbers on consumer confidence. And when you say, well, does it feel like it? A lot of people do not think that it is. As a matter of fact, University of Michigan put out its June estimate for consumer sentiment. It declined to 65.6. I'm not going to get into how the metrics work, but they go between 0 and 100. And the 65.6 is the lowest reading of 2024. So consumer confidence came out, trying to look at what day this was. This was on June 14th. Contained a message for everyone interested in the market. This, according to Jim Bianco of Bianco Research, it was much worse than expected. Driving this was the fact that there is I could get into political, but there's more rhetoric turning sour on the economy from groups that have, at least in the recently, been more positive on the economy, driving a positive rhetoric. They're now starting to drive a more negative narrative, and there seems to be some, at least in his interpretation, some potential concerns of election results in the fall. But overall, it does look like, again, the stock market may, the S&P may have hit a new high, but the old saying, we love this, you don't know who's swimming naked till the tide rolls out. That's a great Warren Buffett speech. It feels like there are people out there now starting to think that maybe under the tide, there's a few people who've lost their bathing suits.
Yeah, there's, I agree. I think there's, I've had this sense in the last, I don't know, month or two where it just seems like the market's still going up and no one's participating. Like, that's how it feels. No, obviously that's not true because the markets are still going up. And so I think, we always have to be mindful of the fact that no matter how we feel, no matter what we think, we could always be wrong. And the market is notorious for this, where things are irrational. As the saying goes, the markets can stay irrational longer than people can stay solvent. Try shorting the market here, right? You get your face ripped off, as they say in trader speak, because the reality is what we think is true isn't necessarily true, right? We've been talking about how real estate should be dropping on the show for a while. We stopped saying it because it's absurd how real estate just keeps going higher despite the fact that people can't afford to buy real estate. Now, that being said, a lot fewer people are participating, right? Same thing here, right? As the markets go higher, I wouldn't say fewer people are participating, but fewer stocks are participating. 12 stocks are hitting all-time highs, and yet the market's hitting all-time highs. That's really weird, right? I'm gonna share some other themes because I think it's really important when we look at. We haven't done this in the show for a while, but when you look at comparisons, now here's Grant Hawkridge. Here's a tweet. I'll share this. So here's some things. So a lot of times, what you'll do if you want to see what a theme is you'll do comparisons or ratios. And so if you're doing like a Russell 1000 growth versus value, okay, that basically our index is a growth index versus value index. Well, what this is saying is that growth is outperforming value, right? And you can see here in the chart in the lower part, growth is outperforming. Well, we know that because those 12 stocks are growth stocks, and largely big tech. Even Apple's broken out from its, I think, year plus hiatus of growth. So, everyone's taken a turn, but we're starting to see growth take off. Here's another theme. The S&P versus the Russell 2000. Well, that's basically large versus small. So it's looking like this ratio, the ratio keeps going higher. That the S&P is outperforming the Russell 2000. We've known that because the Russell 2000 has been underperforming for quite some time. And that's small companies, right? And the small companies are a little closer towards mom and pop companies, right? And large companies are basically, we know they just keep growing. Like that's been a theme for quite a number of years. So that's nothing new. But that theme is still going. And then, of course, you've got the U.S. versus the rest of the world. Well, that theme's been going on for quite some time, too. And it's also picking up. Earlier this year and last year, other parts of the world started to take off. But right now, the U.S. has really, really picked up. So, I think it's really instructive to see these comparisons. Let's see. I'm also going to show you one more, which I thought was interesting, and I'll flip it back to Doug here. So here's a tweet which had some charts here, which I thought was interesting as well, which shows the original Dow theory versus modern Dow theory. Now, I'm going to explain the Dow theory really quickly because probably most people haven't heard of it because it's an old theory. Now, the theory goes that if you're comparing Dow Jones Industrials versus Dow Jones Transports, right? So the industrials are companies that make things. Transports are the companies that transport things, right? That's self-evident. Um, so typically they should confirm each other. The Dow Jones Transports are moving stuff. You can make as much stuff you want, but if the moving stuff companies are declining, well, then that's a sign, right? They're not confirming each other, right? They should confirm each other in their movements, generally speaking. But lately, we haven't seen the transports confirming. They've done less well than the industrials. Now, there's been this theory for a while, which is the original Dow theory doesn't work anymore. Now, I don't know why, because we still have to move stuff, right? You still have to ship stuff.
We still need to manufacture stuff, and industry is still behind everything.
Right. But if you look at the modern Dow theory, people hypothesize that the old theory doesn't work because everything's electronic now. Okay. So what they're theorizing is that the semiconductors are the new confirmation. They're the new transports, if you will, which makes sense. Now, granted, we're still buying stuff, but you are getting a lot more digitally. So, okay, I can buy that there might be some validity behind that. So it's comparing the S&P to the semiconductors. Obviously, you can see they didn't use the Dow because the Dow is going sideways. So I would say maybe it's a chart crime a bit because we're not using the Dow, we're using the S&P, but I can't knock it too much because the S&P is a better metric anyway. So we're going to go with it for this. But basically, it's showing the semiconductors and the S&P. Well, maybe it's the semiconductors that are pushing the S&P. Could it be Nvidia? I don't know if it's the second largest company out there that is going like gangbusters, that's pushing the index. It could be that. It could be just that one stock. So I don't know. You know, when we look at things like that, I just point them out not to say that, oh, well, this is the way it is. I just point it out because it's interesting, right? I don't go look at this and say, well, Dow theory says this. I look at it and say, well, here's another bit of data that shows something. Let me put it in the back of my head and say, all right, is this confirming or denying my thesis of what's going on? And that's how you have to look at a lot of these things is you look at it as an aggregate, not specifically like this is the best thing since sliced bread. There is no such thing in the market. It doesn't exist. All you can do is you can look at an aggregation of a lot of data points and say, are all of these things adding up to things making sense or not making sense? If you're looking for one data point, which I know is how the human brain works, you're going to be disappointed because there isn't one. Even something that's right 90% of the time, it's not right 100% of the time. Now, you might say, well, that 10% of the time, what is correct during that 10%? That would be a valuable piece of information, right? So over the years, I've had a lot of clients, and I've always had a handful that are the indicator, they're the anti-indicator. So they always want to buy at the top. They always want to sell at the bottom, almost to the day. It's a weird thing. Some people just have this, but it's a very valuable piece of information for me because I know when they come out and say I want to buy, I'm like, all right, time to sell, right? And that's a data point. So that's the best you can do is find as many data points you can and try to aggregate them and in your own mind help piece together the puzzle of the markets.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone and the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods, higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
What else is next, Doug? What's on the list?
So one of the things I was taking a look here. I had a question. You pulled this one from Stansberry, and I kind of wanted to get your thoughts on this. Actually, returns, dear, since we are an election year, so there's certainly and one of the things that that Jim Bianco was talking about is, of course, that the consumer sentiment is part of what he was interpreting from the data was a shift in belief of who would be elected this fall, and that creating some change in sentiment. But I saw this post that you put from Stansberry about returns during Republican Democrat unified government control. Now, I know historically that it has generally been in this order where the stock market has performed the best. It has usually been a Democratic president with a Republican president with a Democratic Congress, I believe was number one, followed by a Democratic president with a Republican Congress at number two, all unified Democrat president Congress number three, and then all Republican number four. But this was some interesting data here that looks like it showed that the returns for a unified Democratic and Republican Congress, at least looking at the years that those have occurred, 13 years Republican, 34 years Democrat, it's showing that it is exactly the same return for both of them.
It makes me scratch my head. I wonder if that's accurate, but yes, that is what they said. Yeah.
Okay, just curious. I saw that was posted there, and I wanted to kind of get your opinion. It seems to be a little bit too clear when you start to see the same exact number when you're talking into percentages and stuff like that. So,
a little too on the nose.
What'd you say?
It's a little too on the nose when you see something like that. It's almost like it's either the way I look at this as a quote unquote chart crime is it's a little too convenient. Either someone got the numbers wrong, or it's just a magical coincidence that they just picked this day and they're like, or they're waiting for it and they're like, oh, it's identical. I'm not saying they did that, but it's a little too on the nose, right? It's when a stock market returns 0.00% return, like somebody tried to make that happen. Like that's not normal. Like that doesn't happen. So anyway.
Yeah. Well, the other thing I was going to talk about is you mentioned Nvidia maybe being the two or three company. It's actually the three now because of a couple things. First of all, it's interesting because we had talked about this a couple months ago about the list of the largest companies by market cap. At the time, I believe Saudi Aramco had become the number one company in the market. It just tells you how volatile this is based on the movement of the markets. Saudi Aramco is now the sixth largest company in the world. Ahead of it is Amazon at number 5, Alphabet, Google, at number 4, Nvidia at number 3. Number 2 is Apple. So, and this is interesting because Apple, there was some pressure put on Apple to start coming out with an AI. And again, we just talked about Nvidia at number 2. Now it's number 3. What's that all about? AI. Google released that they're going to start implementing AI in their product. There's a backlash from Elon Musk saying he would never allow that use because of security in his company. So it's very interesting to listen this round. But the number one company in the world who's continued to be just absolutely dominant is Microsoft. And they are currently right above Apple and Nvidia at a $3.2 trillion market cap. Their price as of today is $442 a share. Microsoft is just absolutely dominating everything right now and has continued to be really, really strong. From another standpoint, I'm bouncing back and forth here. I apologize there to look at some stuff. You talk about the declining breadth of the markets. I wanted to kind of look at a little bit, just kind of a shift here We talked a little bit about this last time with inflation. We started to get into it a little bit, just looking at kind of where inflation kind of hit. Again, we talk about consumer sentiment. There's no question that inflation is going to be something that's going to contribute to consumer sentiment. I mean, and of course, it contributes to the impact of elections as well, because how people feel about the economy has often been a driving force in elections. And right now, in some of the polls, you're starting to see a shift that's pushing towards, even though he's been convicted, Trump is looking like he's kind of got a pretty solid lead against the Democrats. And they're saying that they think that's some of the reason some consumer sentiment has shifted because of predictions on who may win this election. But we talked about this a little bit last time, but motor vehicle insurance has been exceptionally high. I've got a daughter that just turned 15, as we talked about, Kirk. I was talking to a family this weekend that was paying $3,000 every 6 months for their insurance with a new child that's driving, granted, an added car. It's cheaper to buy your car. Used cars have gone down. All items, though, between 20 and 21%. And when we look at that inflation side of it, you start to wonder kind of where the benefit is going to be in terms of kind of helping to combat against that. What I was looking for some data and kind of look at, and maybe you've done some research on this, but when we look at kind of inflation, we look at sometimes inflation is tied also to the strength of the dollar. There was some news last week about the Saudi Arabia supposedly not renewing their 50-year, their 50-year U.S. dollar as the currency, as the currency for oil trading. Kirk, have you pulled up anything about or thoughts on the impact of what that would have, that's going to have potentially going forward with regards to, the dollar and the economy for just kind of the world using that as the benchmark currency?
I don't know I have any charts, Doug, but I can tell you it's going to be a complete disaster if that happens. I mean, the U.S. dollar has been the global reserve currency for quite a number of decades, and when that changes, and it will change, right? It always does, right? If you look back in history, it's changed multiple times where certain countries have been the global reserve currency, and the U.S. has been for I don't know how many decades, but it's been quite a number of decades. And I'll tell you that if that happens, if you look what happened to England when England was a reserve currency and then it went off, it completely messed up their economy. And, there's some good and bad parts. It's basically what it is power and control. If you really think about it, what it does is it gives the U.S. power and control. But it also requires that we carry a deficit or a debt, right? And so we can't be fiscally responsible with being a global reserve currency. Like long term, it just doesn't happen. It can, but it generally doesn't. And so we got ourselves into this bind where we have all this debt, and in large part because we're the global reserve currency, and you have to balance trade and you have to take out debt. There's a lot. It's a complicated thing, and I'm not going to go over it in the show, but it's really complicated. But the point is if you look at it historically, countries who've been the global reserve currency in the past have also carried a debt, and it's ruined their economy, especially when it comes off. We're not going to be able to sustain this. So I would gather probably in the next 10 years, we will no longer be the global reserve currency or some derivative thereof, right? Maybe it won't be completely, because going off completely right away is probably not going to happen. It'll be gradual. Just like, China gaining global control financially is also happening gradually. It doesn't happen instantly. So I'm not sure that the world is ready to go China being the global reserve currency, because a lot of things people just don't trust China, like just numbers and a lot of stuff. And it's not really a free market over there. So I'm not going to say they're going to be it. I think it would be more of a aggregation of different countries. I think that would be more logically the better solution. So one country doesn't take all the burden, but also spreads out the power. So maybe that's a good thing too. Either way, point being is it's going to change. It's going to change a lot. And we're not going to like it. I'm just going to tell you that. We are definitely not going to like it. Most likely, it's going to cause a lot of inflation. It's going to cause a lot of disruption economically. And we're not going to have the same control and power we had before. Just like globalization allowed us to have cheap goods, it's going to change. And I think we're not ready for that as an economy because we haven't seen it in our lifetime, so to speak. Some people maybe, but for the most part, we haven't seen it. So we don't know how that's going to react. We can look at history, we can guess, but we really don't know because our economy, like anything, any big change, if we're not prepared for it, that's the problem. It's not the fact that, it happens. It's the fact that we're not prepared for it. Just like right now with higher inflation, people aren't ready for it. Like people don't understand, why is the market still going up? Why is real estate still going up? Why are these things happening? It happened in the 70s, mass confusion. People don't understand cause and effect because the underlying numbers have changed, or the factors have changed, and we haven't experienced those factors before, so we don't know what the outcome is going to be. So all you can really do is just prepare for more confusion. That's all you can really do, is just be more agile in your thinking and say, okay, I understand things are going to be different. I don't understand that exactly how, but I should be more agile in my thinking and accept the fact that cause and effect will operate differently now than it did before. And I think that's really the best you can do, is just be more agile. I do want to quickly pivot back to a few charts and hand it back to Doug here. So there's a few here that I want to go over, which is getting back to the indexes. In this kind of gets into moving averages. So if you're going to look at moving averages, and for those of you who don't know what a moving average is, a moving average is basically, it shows how many, if you look at the 50-day moving average in the case of this, right? So it basically shows that you see the stock charts going up and down, up and down. Well, there's a moving average, which basically smooths out for 50 days, where the price is. So it tends to have a similar shape as the indexes, right? If the index are going up, it goes up. The index are going down, it goes down. But there's usually a crossover, and there's a lot of this that gets into the technical trading, which I'm not going to get too far down the rabbit hole. But basically, it's a part of technical trading that people follow, and it's actually a pretty standardized one that most people look at. Now, when the moving averages are going up, that's a good thing. When they're going down, it's not a good thing. But when you have the number of stocks above or below, so each stock in the S&P also has its own moving average, right? You have the S&P has its. But when you have the number of stocks below, so if you have stocks that are below the 50-day moving average, that's bearish generally. Stocks that are above are bullish generally, right? But when you have currently let's see, the S&P 600, S&P 400, and S&P 500. So you have pretty much every single one of them have more than or less than 50% above their moving averages. So what basically you're saying is most stocks are bearish. Only 36% above for the S&P 600, 39% above on basically S&P 400, and the S&P 500 only 44%. That's, if you look at the chart here that we're sharing, you'll see that it's definitely more of a bearish tone. It's not the worst thing in the world. We've definitely seen worse, but it's not a good sign. If you look at comparison of sectors, the S&P, looking at the S&P 500 sectors. So the tech sector, including AI, is doing really well this year. Every other sector is down, according to this. If you compare well, maybe not all of them. It's not all the sectors, but it's communications, IT, hardware, software, and semis. This is just tech. So within tech, everything's down except for semiconductors. So semiconductors are blowing it out. I mean, they're up 48% as a sector, and every other sector is down. So just be mindful. Even within tech, you're not seeing uniformity. You're basically seeing semis, i.e., Nvidia, because Nvidia is such a large part of that's taking a large part of that gain. If you look at this one, this is basically, I wouldn't say it's a chart crime, but I just thought it was an interesting. It's interesting how people pull data. It's like I've never been into this with sports, where you get some people that are statisticians. Like I had a guy in sixth grade. He was, I mean, he didn't learn anything in school, but he remembered every single person's batting average back like 60 years. I mean, he knew everything when it came to sports. When it came to school, he wasn't very smart, but he was really into the stats, right? And so kudos to him. But if you look at this, basically it's looking at the S&P's on track for new highs, except more. Let's see, more NYSE issues hitting 52-week lows than highs. More NYSE issues are declining than advancing, and the volume is flowing into losers than winners. Those aren't good signs, and yet we're at all-time highs. Over the past 60 years, it's only happened a few times. It happened in 95. It happened in 99. It happened in 22. We're seeing a lot of correlation here. These aren't good correlations, Doug. Of course, correlation is not causation. So anyway, I wanted to point those out. Just some interesting facts that kind of support the thesis that maybe you ought to be cautious right now rather than taking a lot of risk. You're up, Doug. You shared a few funny memes here. What's on your plate?
Well, bouncing around from here to there. I think I think I would stick, since you're talking about obviously the technology and artificial intelligence. It's driving absolutely everything. So if you look at kind of the last thing I posted, right there, it's got a picture of basically. Looks like the warlord, Nvidia overlooking his people out there, the peasants out on the field. Right now, like you said, technology has been the darling of the S&P 500 for some time. I mean, for the longest time, the top 10 movers in the S&P 500 was tech, and then Berkshire Hathaway. And guess what? It hasn't changed much. What's different about it now is that you're not seeing the same just kind of growth laden tech in general driving the market that it was. Now it's all about AI. Apple, actually, if you look at those, if you go back to what you were talking about, a couple minutes ago, with how many of these companies in the tech sector were generally below their 50-day moving average. Well, one of those companies was Apple until last week, and all it took was a pop of them coming out with Apple Intelligence or revamping Siri. And actually, it's really funny because somebody posted a meme that I didn't put up there, where basically they said that Apple is redoing Siri because of Larry David and Curb Your Enthusiasm. And I don't know if anybody watches it, but he did an episode in the last, I think it was this past season, where he basically for 10 minutes in the episode, he's screaming into his phone, trying to get Siri to understand what the heck he wants Siri to do. It's so they're basically correlating that Apple has decided to implement and redesign Siri because of Larry David. But Apple is, but AI is driving everything. What's interesting, and I saw this, I'm trying to pull up an article here, but I saw something a couple of days ago. So I'm just going to talk at the high level on this, and we'll see if we can find some more about it. But one thing that CIOs across the industry, so CIOs is chief investment officers, not to use acronyms that people miss on, but they're basically the people that drive the technology planning within companies. The majority of CIOs have come out and they've actually stated that the implementation of AI, they are struggling to find a way to quantify a return on that investment. In other words, it's popular right now. It's the wave. Everybody's talking AI. It's hot. It's incredible. First of all, it's incredibly expensive to implement it, and that's why Nvidia is doing incredibly well in their stock. But second of all, it's once you do implement it, where is the revenue stream for the value that's going to come from implementing? So I'm going to try to find some more data on this for a future conversation, Kirk, but it was a rather tempered and yet almost bearish kind of sentiment from CIOs about really where this is going and how this is actually going to be of value to the bottom line of companies. The other thing that I want to jump back to, because I just kind of found some things on it, is some memes on inflation. Again, we keep talking about that, over and over. But there's a video that we found on it. We can look at that for another time. But if your parents made $80,000 in the 90s, and I did not fact check the math on this, but it's basically saying you'd have to make $240,000 in 2024 to have the same life. Now, my guess is that $80,000 in the 90s is probably $80,000 as of 1990, probably maybe not by 1999, but still, that is a 3x change on the amount of money that you have to have the same quality of life. And if you look at kind of where inflation has been and why we've gotten to the point where housing prices have gotten to where they are, to where everything has really expanded. We really did have an incredibly comfortable inflation outlook for a long time. That we're now feeling a difference of. So they went through Resi Club. I guess that stands for real estate. I'm not sure. They show a house in their logo, so I'm not sure if their focus is residential real estate. But the source is the Bureau of Labor Statistics, so coming from government wrappers. But what they were looking at as from the 1990s versus the 2000s versus 2010 through 2020s, the most subdued inflationary period was the 2010s. So 2010 to 2020, which I don't think, based on if you've listened to us, anybody's going to argue with. We had just incredible amount of cheap everything for that period of time, which is part of what's driven today. That's that pendulum swing. If you go back and look at before this decade, the worst was actually the 1990s. So again, going back to the other graphic where you said, hey, there's what you could have made in the 1990s, or you'd have to spend the 1990s versus today. The 90s drove a massive amount of inflation during that period. It was a 33.7% in consumer price index change. Well, we are already, we're only halfway through. We're only 4 years, but roughly halfway through the 2020s, and we're outpacing the last 4 decades prior to that. And we're with a 21% consumer price index. Again, is this a surprise to anybody? Absolutely not. But when you start to take a look at, kind of how that relates to, the previous decades. Now, I would love to have seen the 80s and 70s in this chart, so we could say that it's definitely a little bit of a chart crime to compare kind of how we feel now compared to what people were feeling back in those decades. I would love to see, because we talked about this before. Are we feeling, is this a little bit like the 70s and stagflation? Is it a little bit like the 80s? 80s were great if you had assets, you could get 18% to 20% cash on your money. Nothing, even now you can't get that kind of return on cash. So I'd love to see that comparison back to the 70s and 80s. Unfortunately, they crimed us there and didn't show that. But clearly, over the last 40 years, we are feeling something. And what's really interesting is if you look at the 2020s, I look at the beginning of that chart, we actually started out slower and a little bit even better than the previous 4 decades. But obviously that rapidly spiked, as we all know, coming out of COVID and a lot of reasons that we've now driven inflation, liquidity that's driven a lot of purchasing against, as we talked about before, a fixed amount of goods. Inflation is what it is, and it's now it's going to be with us here to stay. I don't think we're going to be settling in. So,
yeah, no, I couldn't agree more, Doug. And getting back to the chart crime of this chart, obviously it doesn't show the 70s or the 80s, which were higher. And so anytime I see these, I always laugh, because when they're missing something, it's because it doesn't line up with what
the narrative.
With the narrative, exactly. Charts are a narrative, right? You could do a video, you could do text, you could do audio like we do, or you could do a chart, right? You could do visual. This is a narrative. And the narrative is, hey, look how high inflation is. Okay, what about the 70s and 80s? It probably isn't going to line up with the narrative they're trying to pitch. because the 70s and 80s definitely were higher. But if you do look at this, what is interesting, even if you had that, right, what you'll see that starting from the top, the highest lines, that starts in the 90s and the 2000s and 10s, and it's basically, it goes down each decade. But what'll be interesting about the 80s, the 70s and the 80s is because the peak was really like 80, 81. So it's really at the turn of the decade. So I'd actually be curious to see if somebody did that. It'd be interesting chart to see for sure.
I want to show one more if you don't mind, and I think it's hysterical. Is the lady with the shopping cart?
Yeah.
A woman with $20 of groceries before going home to her $15,000 house. So this is basically saying that the actual mean price of a home in 1980 was $50,000, and I can concur that. The house that we bought previously, we bought a house in 2012. The people that we bought it from had previously, they were the second owners, and they had bought their house in the late 70s for like $70,000. So it's incredible to see what happened there. We did not pay $70,000 for that house. I think it was worth over $400,000. So the actual mean price of a home in 1980, $50,000. The average salary, $12,500. Inflation rate, so this is giving you a little bit more of a taste of what it was back then, 14%. Unemployment rate, 8%. Mortgage rate, 13%. For those of you that are complaining about a 7 or an 8, a reminder, this is actually much closer to norm than what you've been tasting for the last 15 years. But it said, I love this. The woman with $20 of groceries going home to her $15,000 house in the 1980s. Now, let me tell you what I find funny about this. I look at that shopping cart and I think, and of course, the next 3 generations are already dead from the diet.
Yeah. Hawaiian punch. You see how big that can is of Hawaiian punch?
I love that. Yep, the grape Hawaiian punch, Schweppes ginger ale. You've got the white rice in there. You've got the white cornflakes. You've got the old Hostess Suzy Q's, which were made with the best of trans fats. Then you look at the Mueller's white seashells. Basically, this is the American diet wrapped up into one picture. White flour-based white grain and sugary drinks.
But Doug, that was the base.
God bless America.
but that was the base of the food pyramid, Doug. You had to have a lot of grains in your diet for the food pyramid. I mean, this woman's obviously doing a good job for the 1980s, which, whatever. I agree that this picture is funny on so many levels. I mean, you look at the dress, like this is very 1980s, like how she was dressed, and like the shopping cart full of stuff. Like, if you think about it, this actually isn't too far removed from, I would say, 2019, prior to COVID, or that's when inflation started to pick up. If you look at before, actually, no, I'm sorry. This would have been prior 2008. So prior to 2008, I remember my wife and I used to go out to eat all the time, and we'd go to the same restaurant, and we'd get similar things, and it was just our weekly thing. And at one point after 2008, they started to shrink the meal sizes. Before that, it was like, how much food can we shove on your plate to make it look abundant? Like, oh, we got to give you more. And it was always more food, more of this, more of that. And it was always this like, the more, the better. And then it started to shrink after 2008. And we started talking to them. We're like, wow, you guys, like, this is a smaller meal. I mean, it was, it's still fine, but I'm like, what happened? They're like, well, the economics are such that we're struggling, so we got to shrink the food sizes. I'm like, okay, that's fine. And it kept shrinking. The quality kept shrinking, and then that kind of stagnated for a while. And then after COVID, it started to happen again. So the restaurants obviously struggled, and so what started to happen was we started to see that I'm a creature of habit, so I tend to go to the same places. When I see things happening, I can pair it against itself. So, people kind of stayed static for like the first year or so after COVID. And then like the second year was like, all right, we're going to shrink the meal size a little bit, right? And I would get like a quinoa bowl or something. So it was like a certain size. It would shrink. I'm like, oh, that seems a little smaller. Then they started substituting. So they started substituting the more expensive foods for some cheaper foods, and they would do less of them. and then the meats were smaller, and it would just keep shrinking. And now I go there, it's like, holy crap! Like I'm basically getting quinoa with a few pieces of broccoli and a really small piece of chicken. Like, what am I? I'm just basically buying quinoa. Like what? Like,
Yeah.
And not only that, but the prices have gone up a lot. Like the prices have doubled from where it used to be. And so it's just, I find this amazing because this is the hidden tax. So if you want to know, like, oh, taxes are going up. No, they're not. Inflation's going up. It's the hidden tax. It's the tax that very few people are aware of. Even if you're aware of it superficially, you're not really paying attention to it, but you feel it in your pocketbook or your wallet, right? You feel it because it's a hidden tax. The government doesn't need to tax you anymore. They don't. All they need to do is just keep spending your money, spending more than they're making, and they just keep taking on debt, and inflation keeps going up, and that's a tax. And that's why this $20, carriage full of groceries, which the quality is very poor, as Doug and I point out, but this carriage full of groceries for $20 would probably now cost about, I don't know, $400.
Easily.
I mean, it's crazy.
Yeah, and I think that is a great example of shrinkflation. I think you pointed out, there's three things that I kind of point out of this. First of all, if you look at the size of these, she's at like some mom and pop groceries, which don't even exist anymore, right? Yeah. It's all the super. The sizes of the items that she has in that cart are bigger than some of the same comparable sizes you'd buy at Costco now. Like that Maxwell House, that's a Costco size can. You can't find that at the grocery anymore. They're this big. So there's a couple things that come to mind when you think about this. First of all, I think you talked about the quinoa. I think part of inflation is just Americans getting more diligent about their diet, right? When people used to joke about whole paycheck because Americans started to actually think about the ingredients of their food. And it is sad to say, to get high ingredients, they had to pay a lot more for it to get something that should be healthy. So people started to get a more expensive meal anyway to try to get actually whole grains and organic. The second thing is you think about the shrinkflation. Is that not only that, not is it more expensive for what you get, now you got to go back to the grocery over and over. So you're shopping more and more. So that same cart would be 400, but you'd get less for it. So now you're doing that 400 times 3 because how many times you got to go back. And the last thing, and this is something I really want people to think about. This is where it really is almost a conflict of interest. Now, maybe not so much with the federal government, but definitely with state governments and in other areas, because with inflation, and maybe a little federal, inflation does drive up wages to a degree. Now, are they comparable to the pricing? Not exactly, but wages go up. But also pricing goes up. And we have governments that tax on inflation, tax on income, and we have governments that tax on sales. So if you think about this, there is actually again, I'm not saying it's an actively conscientious thought through these think tanks, but you never know with the government. But the higher inflation is, the higher wages, it creates more tax revenue, both at the state level with sales taxes, also at the federal level and state levels with income taxes. So from a revenue standpoint, this actually has a benefit to governments to see you paying more, because it means you're earning more and it means you're paying more in taxes. So
yeah,
something to think about, food for thought.
Yeah, let's wrap it up here in the interest of time here, Doug. You want to give final thoughts and we'll wrap it up. I had one more thing I wanted to discuss. So your point about inflation and the government, here's something to keep in mind. The government doesn't have inflation. We have inflation. Here's why. Inflation starts with the printing of money, right? The printing of money, which basically is given to the government through debt, right? So the government basically borrows money and then uses it. So they borrow money. So let's say we have $100 in circulation and the government borrows $100. Well, now there's $200. You double the money supply. The government can spend that. But when they spend it, that's when inflation happens. Before that, it doesn't exist, right? There's only $100. So even if they printed another $100, it doesn't exist because no one's using it, right? So it's like it doesn't exist in the economy. As soon as they spend it, it doubles the money supply. So now your $1 is worth 50 cents because now there's $200 instead of 100. So effectively, the government doesn't participate in inflation. We do. So when it's printed, immediately inflation happens according to the definitions, right? It happens. And then now we participate. So the closer you are to the government teat, right? If the government's giving you money, you participate in inflation a lot less than somebody who's 2, 3, 4 people down the line. So the closer you are to the government teat, the less inflation that you participate in. I know this is a little heady conversation for a Monday, but just understand that the further you are away from the government teat, the more inflation will impact you. And so the people who are getting on welfare, people who are getting Social Security, anyone who's getting money from the government, you have less inflation technically than everyone else. So anyway, Doug, wrap it up here, and we'll head it home.
Yeah, fantastic point there. So inflation, it's affecting everybody, and if you have kids like I do, I'm thinking very heavily about the next 4 years, and I've got to have one, kid in college, and then I'm going to have another kid in college. And if you're basically my generation, we're all facing that. And if we're talking about inflation, we are talking about real concerns over the price of college. This is no joke. There is $3 to $4 trillion student debt out there, an average of about $35,000 per family or per student out there figuring out how to pay on debt. 35,000 as an average is actually not that much because our families out there with several $100,000. Don't let this be you. I see these chat sites out there, people trying to figure out, how do I get more money? It starts with understanding how to get a good academic degree with a return on investment. Secondly, it's about how to make sure that your student gets there and graduates on time in 4 years and actually enjoys their time there. That's the social side. And the last is finding where you can get the discount. There are seller schools and buyer schools. Buyer schools are going to make you pay more. They are marketing to make you more expensive and to make you pay full price. And most people do because of the belief on that return investment. Seller schools are out there willing to give discounts if you know how to get the money. And ultimately, if you have a plan to get a great education at less money and a plan to pay for it, you can save hundreds of thousands of dollars and have a better outcome. If that's important to you, do the research, get the information. Maybe it's from us. Check out our website, mergentcollegeadvisors.com. That's MERGENT, MERGENT, mergentcollegeadvisors.com. Start by getting some free information. And again, if you have any questions, we'd be happy to talk to you.
Great. Well, thanks for joining us this week, Doug. Always wonderful to connect on a Monday here.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.